So, should you put your money in the S&P 500 or in the MSCI World? At first glance, the choice feels pretty straightforward. The S&P 500 has delivered stronger returns, and American companies are already present all over the globe. So why bother with a global ETF that's more diversified but less profitable? Wouldn't it just make more sense to invest only in the US? In this video, we're going to break it all down. We'll compare both indexes, look at their performance, and see exactly where the biggest American companies actually make their money. And at the end, I'll share which one I personally decided to invest in. Before we jump in, just a quick reminder. I'm not a financial advisor. Everything I share here is based on my own research and decisions. If you like this kind of content, don't forget to subscribe so you won't miss the next videos. All right, let's get into it. Both the S&P 500 and the MSCI World are stock market indexes made up of hundreds of companies. They're used as benchmarks by many ETFs, which allow investors to easily replicate them. The MSCI World is managed by Morgan Stanley Capital International, better known as MSCI. They're also behind other well-known indexes, like the MSCI Emerging Markets and the MSCI Europe. The S&P 500, on the other hand, is managed by S&P Global. You might recognize their credit rating agency, formerly called Standard & Poor's, which today goes by S&P Global Ratings. Now, the key difference between the two is geographic. The MSCI World includes stocks from 23 developed countries. The S&P 500, on the other hand, focuses only on US companies. There's also a difference in how they're built. The S&P 500 always includes exactly 500 of the largest American companies. That number doesn't change, but the share of the total US market it represents can shift over time depending on how those companies grow. The MSCI World works differently. In each country, it selects the biggest companies to cover about 85% of that country's stock market. That means the number of stocks in the index can move up or down. Right now, it includes around 1,300 companies. To really understand these two indexes, let's examine their geographic composition. With the S&P 500, it's simple. Every single stock is American. The MSCI World also leans heavily on the US, simply because American companies take up such a big share of the global economy. About 72% of the index is in US stocks, and the remaining 28% is spread across other developed countries. Among those, the biggest weights go to Japan, the United Kingdom, Canada, and France. When it comes to sectors, the two indexes look quite similar, with technology clearly dominating, thanks again to the weight of US stocks. In the MSCI World, the tech sector makes up about 26%. That includes software companies, hardware manufacturers, and semiconductor firms. The next largest sectors are financial services, industrials, healthcare, and consumer discretionary. In the S&P 500, tech has an even bigger role, around 33% of the index. After that, you'll find financial services, consumer discretionary, communication services, healthcare, and industrials. Now let's take a closer look at what's actually inside these indexes. The top 10 companies are pretty similar across the board. The 10 largest companies in the world are all American. In the MSCI World, Nvidia sits at number 1, followed by Microsoft and Apple. After that come Amazon, Meta, Broadcom, Alphabet A, Tesla, Alphabet C, and JP Morgan Chase. The S&P 500 is almost the same at the top. The first 7 companies match the MSCI World exactly: Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, and Alphabet A. Then you have Alphabet C, Tesla, and Berkshire Hathaway. Where the two really differ is in diversification. The S&P 500 is 100% American. Every single one of its 500 companies is based in the United States, so there's no geographic balance at all. The MSCI World, on the other hand, spans 23 developed countries, which brings a level of balance. Right now, it includes around 1,325 stocks, though that number can shift and is usually close to 1,500. With so many companies, the influence of the very largest ones is naturally smaller. In the S&P 500, the 10 biggest companies make up nearly 1/3 of the entire index. In the MSCI World, their share is still important, but closer to 1/5. In short, even though the MSCI World is still heavily weighted toward the US, it's far more diversified than the S&P 500, both in the number of stocks it holds and in geographic exposure. So far, this broad diversification has been the main strength of the MSCI World. But now let's compare the performance of the two indexes since 1980. On average, the MSCI World, including dividends, has returned 8.3% per year. The S&P 500, meanwhile, has delivered 10.9% per year. Volatility is fairly similar for both, which means that at roughly the same level of risk, the S&P 500 has generated noticeably higher returns. Another common argument for sticking with the S&P 500 is that large US companies don't make all their money in the United States. They earn revenues worldwide. So investing in the S&P 500 doesn't necessarily lock you into just the US economy. It still gives you a form of global diversification. If you want to see the details for yourself, the best way is to check each company's annual report. You can usually find them on their websites under Investor Relations. Take Microsoft, for example. About half of its annual revenue comes from the US, and the other half comes from the rest of the world. Apple is a bit different. According to its annual report, 42% of its revenue comes from the Americas, with 36% coming specifically from the United States. Europe accounts for 25%, China for 17%, Japan for 6%, and the rest of Asia for just under 8%. For this video, I went through the annual reports of the top 10 companies in the S&P 500 and looked at how much revenue they make in the US. The result? Almost all of them generate less than half of their revenue in the United States. The only exception is Amazon, with 61% of its revenue coming from North America, meaning the US and Canada. Of course, you could do this analysis for every company in the index, but remember that these top 10 stocks alone make up more than 30% of the S&P 500 index, so they are actually very representative of the index as a whole. The takeaway is this: based on revenues, the S&P 500 is already quite diversified globally. However, this is also true for the MSCI World, which covers the same big companies but in a more diversified way. Put simply, there's a strong case on both sides, but for different reasons. The US index has historically delivered better performance. Much of global growth over the past few decades has been driven by US companies. What's interesting is that this outperformance didn't come with higher risk. The volatility has stayed pretty comparable between the two. But will this continue in the future? Honestly, no one can say for sure. The MSCI World has a clear advantage in one area: diversification. It covers 23 developed countries and over 1,300 companies, and it weights countries according to their actual share of global markets. Right now, the US dominates, but if another developed country were to take the lead, the index would automatically adjust. With the S&P 500, that wouldn't happen. You'd stay fully exposed to the US no matter what. At this point, you might be thinking about splitting your investment 50-50 between the two. But here's the thing: even with that, your portfolio would still be heavily tilted toward the United States, around 80%. For me, I've chosen to focus on diversification instead of just chasing past performance, because history shows us one clear lesson: no economy stays on top forever. At the start of the 20th century, the United Kingdom alone made up almost a quarter of the global stock market. Today, it's down to barely 4%. In the 1980s, Japan was booming. It was one of the biggest economic bubbles in history. Back then, Japan's model looked unbeatable. Giants like Sony, Toyota, Panasonic, and Mitsubishi were dominating electronics, automobiles, and robotics. Everyone believed that would last forever. But if you had invested everything there in 1989, you'd have faced 3 decades of stagnation. Even today, Japan's market still hasn't fully recovered from its peak. Right now, the United States holds the dominant position, but there's also a lot of money being made in other developed markets. Europe is home to leaders like Nestlé in Switzerland, LVMH in France, and ASML in the Netherlands, which is absolutely crucial to the semiconductor industry. In Germany, companies like Siemens and Mercedes-Benz remain powerhouses in engineering and automobiles. In the UK, AstraZeneca and Unilever are global players in healthcare and consumer goods. Beyond Europe, Japan still has champions like Toyota and Sony, and in Canada, banks and energy companies continue to play a massive role in global markets. So when you invest in the MSCI World, you're still betting on America, but you're also spreading some of that bet across the rest of the world. It's not a magic formula, but to me, it feels like a healthier balance than putting everything on one country. In the end, the goal isn't to guess which nation will come out on top. It's to build a strong, diversified portfolio that can stand the test of time. That wraps it up. Questions, comments, leave them below. Subscribe for more, and I'll see you in the next one.